Ladies and gentlemen, good day and welcome to the Q1FY22 Earnings Conference call of Brigade Enterprises Limited. We have with us on the call the management of Brigade Enterprises Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. M.R. Jaishankar, Chairman and Managing Director of the company. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen, and thank you again for joining us for this investors call. We hope all of you and your loved ones are doing well after this second wave of the virus. On behalf of the Brigade Group, I would like to welcome you to this earnings call for the first quarter of financial year 22. I am joined by our executive directors, Ms. Pavitra Shankar and Ms. Nirupa Shankar. Our senior management team is also present on the call. Mr. Atul Goyal, CFO, Mr. Rajendra Joshi, CEO Residential, Mr. Vineet Verma, CEO Hospitality, Mr. Subrata Sharma, CEO Office Leasing, and Mr. Om Prakash, Company Secretary. The second wave really hit the entire nation hard. It was distressing to witness the grief and despair that followed. We were all affected both directly and indirectly as a business. The lockdown stalled our plans, but only briefly. Our team was better poised this time around. Now, as COVID-19 continues to rear its ugly head, we believe we are better prepared to face the next wave of this pandemic. In fact, our team is back in the office and raring to go. We are all vaccinated. Despite a muted quarter one this year, the company was able to carry out a very successful QIP of rupees 500 crores in June 2021, which was oversubscribed 6 times. The funds will predominantly be used for acquiring lands for new projects to grow the residential business primarily. Here are the remaining business highlights from the last quarter. Starting with our residential business, our performance was good despite the severity of the second wave. We ended the quarter with 0.76 million square feet of new bookings with a value of rupees 470 crores. This is a growth of 91% by area and 111% by value compared to the period of quarter one of the last financial year, during which there was a nationwide lockdown. The improved performance this year can be mostly attributed to the favorable macroeconomic dynamics to buy a home, thanks to low interest rates and higher disposable income and improved confidence regarding job stability and salary growth. The positive customer outlook was reflected in the second half of June 21, which recorded a sharp increase in site visits and bookings once the unlock guidelines came into effect. Our projects across Bangalore, Chennai and Hyderabad continue to deliver consistently high results. On the collections front, it was an all-time second highest at rupees 531 crores, driven by continued strong sales performance and good construction progress at all project sites. We would also like you to note the conservative approach followed in terms of reporting our operational numbers. Our pre-sales numbers are always shown net of cancellation of bookings done in current as well as prior periods. We also do not consider bookings towards pre-sale numbers unless a minimum of 5 or 10% of the agreement value has been collected along with all the required documentation. Our average realization is based on RERA agreement value of the customer and do not include any other expenses or transaction costs. On the revenue recognition front, we only report units where the customer has completed the entire registration process and not just taken possession of the unit without registering the property. Coming to the office segment, we continue to focus on collections of lease rentals and are happy to inform that we have achieved 99% cumulative collections in Q1 of the financial year 22. On the leasing front, there was increased momentum in terms of leasing inquiries, RFP releases, request for proposal releases, and site inspections, though decisions are still delayed, primarily because average physical occupancy levels are still below 10% across all office parks. Our outlook is positive owing to robust hiring across IT and ITES sectors, which is likely to enhance the increased need for office spaces as companies commence work from office. We are in discussion for approximately 1.5 million square feet across projects. In addition, we have achieved a strong leasing velocity at the Brigade Center, Gift City, Ahmedabad. Our strategically located and well-designed projects, Brigade Tech Gardens, World Trade Center, Chennai, are attracting prospects because of their superior value proposition, and we are focused on transacting the remaining space within the next 3 to 4 quarters. Moving to our retail business, the lockdown in the Q1 adversely affected our malls. Nevertheless, our focus was on retailer engagement. We maintained a reasonable approach to renegotiation of leases by offering somewhat similar commercial terms as last year's rent relief during the first lockdown. In the Q1 FY22, we billed 40% of the financial year 20 rent in the similar quarter in comparison to just 20% in the last year financial year FY21 of the Q1. After the malls reopened in July 21, we saw a sales consumption recovery that was over 90% of 2020 pre-COVID levels in comparison to just 20% sales recovery from last year malls reopening in June 20. This was primarily because of the improved customer confidence owing to the vaccination drives in Bangalore. We are expecting the retail business to normalize by the beginning of Q3 of 2022, particularly if there are no more restrictions imposed due to any possible third wave, which we hope it will not happen. Almost 1.80 lakh square feet is freshly leased and under fit out. That is 14% of the gross total leasable area across all our malls. These retailers are scheduled to open in phases by end of Q3 in this financial year 22. Finally, to our hospitality business. In Q1, we witnessed an abrupt halt to the positive momentum built in the previous quarters and recoveries made post the first wave. The collective average occupancy achieved by our portfolio of 8 hotels was 23% compared to 43% in the Q4 of financial year 21. Nevertheless, it was still 5% higher as compared to the first lockdown in Q1 of financial year 21. ARRs, that is average rents in the hotels, continued to remain stressed in Q1, having reached close to 60% of pre-COVID levels in Q4 of financial year 21. We saw a 14% gross operating loss in the quarter compared to a 22% gross operating profit in last quarter. The pent-up travel demand and revenge tourism thereafter has enabled hotels to see occupancies bounce back to over 42% in July 2021. The hotels continue to strictly monitor operating costs and other overheads to ensure that we protect our bottom line as far as possible without compromising on the quality of our services. In fact, out of the 8 hotels, 7 hotels have had operating a cash profit in the month of July. We are hopeful the momentum that we see, that we have witnessed in this beginning of Q2 across our businesses continues irrespective of the challenges that come our way. Having said that, we sincerely hope the government's plan to vaccinate the entire adult population before the end of 2021 succeeds. Thank you for your patience. Now, Mr. Atul Goyal, our CFO, will present the financial results in detail. After that, there can be question and answers. Thank you.
Thank you. Good afternoon, everybody. On behalf of the company, we would like to welcome you to the earnings calls for Q1FY 2022. While we had witnessed a bit of recovery in Q4FY21 in all our businesses, the economy was again hit by a second wave of COVID in Q1FY22, which slowed down the recovery pace. However, the momentum has picked up again and after lifting lockdown restrictions, and we expect a recovery in the coming months. On the company side, this quarter has been better than the same quarter ending last financial year, where we faced first lockdown due to COVID in terms of business performance, and the experience has helped us to manage second wave better. Let me give you some key highlights of our performance in the last quarter. We successfully raised QIP of 500 crores, which was oversubscribed by 6.25 times. I am also happy to announce that our rating has been upgraded to ICRA A+, further strengthening the confidence of stakeholders of the company. We have recorded 83% growth in real estate sales of 0.76 million square feet during this quarter, vis-a-vis 0.42 million square feet during same quarter last financial year. For Q1FY22, the sales value stood at 480 crores, recording a growth of 92% over the same quarter last financial year. As on 30th June 21, Brigade has approached 18.11 million square feet of ongoing project, and we propose to launch 1.91 million in ensuing quarters. On the leasing side, we achieved 99% rental collections with gradual increase in reoccupancy in the operational portfolio. We achieved new leasing of 1 lakh during the quarter, and we have an active pipeline of around 1.5 million. On the retail side, the impact by lockdown during the second wave was severe, but footfalls have been improved considerably and mall occupancy has been around 85%, expecting faster recovery. While we have a significant uptick in the hospitality performance in Q4FY21, the second wave and renewed restrictions impacted the hospitality business occupancy. Occupancy stood at 23% in Q1FY22, vis-a-vis 11% during the same quarter last financial year. It has witnessed a gradual recovery in July 21, but the long-term recovery is dependent on corporate and international travel amid COVID cases. On a consolidated level, there was an increase in cash flow from operating activities by 89% from same quarter last financial year. We have surplus liquidity and undrawn credit lines of 300 crores from banks. Our average cost of debt has been coming down consistently over last few quarters and was at 8.14% as on June 21 versus 9.56 as on June 20, of 142 bps reduction that would result in an annualized saving of around 60 crores per annum. Coming to consolidated financial performance, the consolidated revenues for Q1FY22 stood at 391 crores versus 240 crores for the same quarters last financial year, an increase by 83%. The consolidated other income for Q1FY20 stood at 120 crores as against 58 crores in Q1FY21. EBITDA margin including other income increased to 31% from 27% last quarter. The real estate segment clocked a turnover of 260 crores and EBITDA of 14% in Q1FY22. The hospitality segment clocked a turnover of 20 crores in Q1 FY22, and leasing segment clocked a turnover of 112 crores and an EBITDA of 77% in Q1 FY22. The interest and finance charges for Q1 FY22 stood at 22 crores. Consolidated PAT after MI for Q1 FY22 stood at minus 40 crores. There has been reduction of 80 crores in overall debt in Q1 FY22. The cash and cash equivalents stand at 1,173 crores as on June 30th, 2021. Consequently, the company's net debt outstanding as on June 30th stood at 3047 crores, out of which BL share is 2,117 crores, that is 75% of the debt pertain to commercial portion, and for which 70% is backed by the rental income. I now hand over to the moderator for question and answers. Thanks.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya from ICICI Securities. Please go ahead.
Yeah. Good afternoon, everyone. Thank you for the opportunity. Most of my questions will be on the rental business. First, in the quarter's rental revenue, our rental revenues have been flattish quarter on quarter in spite of the waiver we have given for the mall rentals. So, was the deficit being made up by incremental leasing revenue, or you have taken higher CAM charges for the quarter? Just some clarification on that. You could help us.
The rental has started coming from WTC. It's impact of straight lining. So, of course, we will be receiving rentals in this year. Already Amazon has started there. So, this rental increase will be there going forward.
So then Chennai would have contributed how much for this quarter, the Chennai rentals?
Quarter will be around, 15 crores to 20 crores.
Yeah. 15 to 20 crores. Sir, and based on, and for Chennai now, for the full year, like what is the sort of rental you would expect to collect now, considering current?
I would not like to give guidance, but it should be about 450 crores is what I can say.
No, sir, I am referring specifically to Chennai, the Chennai property. Means how much rental, based on current, whatever leasing has happened, as per current leasing, what would be the sort of run rate, assuming no incremental leasing happens?
In this year, we will do around 75 crores of rental by year end.
Okay, rental by year end. And my next question, obviously, you mentioned about a 1.5 million square feet leasing pipeline. So, could you give us a color, like when is the closure of some of these transactions expected, and in which properties, the breakup which you usually give?
So, this is Subroto. Overall the pipeline, active pipeline that we are having currently is 1.5 million. Okay, and out of this 0.8 million is at Brigade Tech Gardens. 0.5 approximately would be for WTC Chennai. 0.1 is at BIFC Ahmedabad, and rest all together is 0.1 approximately. Now, quite positive pipeline. As far as the transaction closure timeline is concerned, it would also depend upon like how the companies move towards reoccupancies, but a significant portion of these will actually get accelerated. That's what we are getting to know.
Okay, so just to clarify, you mentioned 0.9 in Tech Gardens or a different number? Sorry, I missed.
0.8.
0.8. Okay. So in terms of a target, right, and you are saying 0.5 million for WTC. So you are expecting WTC to be fully leased out? Is that the target we are working with, or an aspiration?
Yeah. So as far as the target is concerned, we are actually expecting WTC to get fully leased out. Okay. The only thing is, as I said, the reoccupancy also will drive the leasing, because see, as far as the site inspection and the RFP release momentum is concerned, we are seeing significant increase. But as you are aware, unless and until they get an understanding that when People will come back to office. They may not actually want to lock into the premises because from that day the count will start for the rent-free period, isn't it?
Sure. So you said WTC you are looking to lease out fully, and for tech gardens, then similar, like we are at almost, yeah.
A conservative would be at least 4 quarters, because see, as I speak, currently we have 0.8, but recently we have also entered into discussion wherein a few more requirements are coming by. Okay, like a few of our existing tenants, they have actually increased significantly as far as the manpower is concerned. Now, when they reoccupy, there would be a need from them also. Okay, and one tenant who actually withdrew last year, they are still having a license, SEZ license in BTG. They are again coming back with the same requirement. So all these positive developments are there. So that's why we feel that as we go forward, this pipeline quantum will also increase.
Sure. And one final clarification. So as Atul mentioned that even assuming with incremental leasing of 450 crores sort of rental is achievable, assuming no increment leasing for the rest of the year. Is that correct?
Yes. Overall, yes.
Okay, 450 crores without incremental leasing. Fine, sir. I'll come back in the with more questions. Thank you and all the best.
Thank you. The next question is from the line of Parikshit Kanpal from HDFC Securities. Please go ahead.
Hi, sir. Congratulations on a decent performance during the quarter. So my first question is on this 1.5 million square feet of pipeline. So how many approximate inquiries or would be covered under this? So to have this size, basically, I wanted to know.
In this pipeline, it is a kind of mixed. Okay, there is one major oil company who are looking at a bigger quantum, that is approximately 0.6 to 0.7, means together, okay, out of 1.5. But apart from that, there are smaller inquiries, mid-size inquiries, as well as anywhere between 1 to 2 lakh square feet as well. It again depends upon the properties and the locations. Okay, it's like, see, in BIFC, that is Ahmedabad, is majorly from many companies. The cumulative of it would be approximately 0.1 million. Okay, so approximately 12 to 13 companies.
So these RFPs, the nature of the RFPs or the underlying segment, so are you seeing any change in the trend that typically earlier ITS companies used to need a lot of space? So is it like this time you're seeing more demand coming from financial services or other companies like manufacturing? As you pointed out, oil and gas is one of them. So if you can just highlight a bit more color on the nature of RFPs being floated now versus a year back or pre-COVID. So has there been any change in the inquiries?
Sorry, I couldn't get your question.
So I was saying that these RFPs which are being quoted in the market, so demand for leasing RFPs. So are you seeing any structural changes in the nature of the underlying segment which are looking out for space? Is it like traditional ITS which is looking out to lease space, or is it more getting inquiries coming in from financial services or manufacturing sector? So any comparisons with the trend which was there pre-COVID and now, so any change in that trend and demand from the customers segment-wise, if you can just give some color on that?
See, as far as the pattern is concerned, though in this first quarter, what we actually know is pan-India leasing, the majority of the leasing portions came from engineering and manufacturing sector. But as far as the RFPs are concerned, we still see that majority of this is driven by ITES. As far as the overall requirement is concerned, so still it's more than 80% ITES.
Okay. My other question is on the
that we all know that it's in sync with the kind of trend that we are seeing in market, because majority of the hiring has happened in ITES. Okay. Now, as soon as they come back to office, even if a portion of them are work from home, they will still need the additional space. And with the post-COVID scenario, I think they will not want to densify. Okay, so it is in sync with the market trend, and it's quite natural that the majority of the RFPs will be from ITES.
Okay. Because the ones you highlighted was more from the oil and gas side, the large part of almost half of it.
So initially, in the first quarter, we are seeing the trend. So it was mostly driven by the engineering manufacturing, because now the ITs are not in office. Okay, now as soon as they come back to office, the requirement from that sector will increase significantly.
Okay, so my second question was on the residential business. Now we have about 1,100 crores of cash. So first of all, how much of this is unencumbered? I mean, how much of this would be lying in extra accounts and all? But so even if we adjust for that, so what would be the cash quantum, and how do we intend to employ it in this year in terms of land payments and land acquisition? So have we finalized any land parcels from the business development side? If you can give some highlight on the BD efforts of the company in this year, and how much of this money will go towards the land payments over the next 2 years?
So these residential collections are mainly in RERA accounts, so we cannot take out that money and use for land. But we have taken that QIP money and will be using that money for buying on land. There are some prospects which is being looked into, and will come back as and when we finalize those land deals in coming quarters.
But likely ballpark capex this year on land, this and next year. So cumulatively, we can just highlight how much you intend to spend on land.
The voice is not clear, Parikshit.
So I was asking that cumulatively this year and next year, how much of land capex are we targeting from the growth perspective? So that is, if you can give some ballpark sense on that.
No, see, currently there is an active consideration for land parcel of about 150 crores. We have entered into some kind of term sheet, but balance are under different stages of negotiation. We may utilize maybe bulk of the money if the right opportunities come by. Everything is dependent on the right opportunities. So it is more like the purpose was to have some kind of a war chest to seize the opportunities that come by.
So just the last question on pre-sales. So last quarter, fourth quarter, we did about 1,000 crores, close to about 1,000 crores of pre-sales. So monthly about 300 odd crores plus. So when do we expect to start hitting that run rate again? How was the July month for you? If you can just give some sense on that.
Yeah. So Q1 certainly was muted. We were nearly at about 48% of what we were of Q4. But July, fortunately, seems to be doing better. But all of it really would depend on the restrictions that will get imposed, because the residential real estate will pick up and do well only if the customers visit the sites, and particularly on the weekends. I think those are extremely important in this business. While we have geared up for virtual selling, etc., I think the customer visiting the site is important. We do see that there is demand, there is potential, but these hindrances or roadblocks will obstruct the growth if they continue.
So how was July month, sir? Has it reached like 200 crores?
Good. As I said, it's an ongoing month. I would say that it was much better than the last year, July.
Okay, sir. Thank you. That's all from my side and on the place.
Thank you. The next question is on the line of Yash Gupta from Angel Broking. Please go ahead.
Good afternoon, everyone. Thank you for the opportunity. Sir, first question is on the residential Bangalore market share. So what's the pre-sales share we are having in the market, and how it's changed in the last 1 year?
So I would say the contribution of Bangalore to our total sales in the last 1 year has come down. It was about 80% in Q1 of last year. It has come down to 60, simply because the new launch in Hyderabad and the new launches in Chennai have done quite well. Today, between these two markets, they contribute nearly to 40% of our total sales.
Sorry. So, sir, my question is, what is the share of our pre-sales Bangalore in the overall Bangalore market? So, is that we are gaining the market share in the Bangalore in the pre-sales number, or not in the last 1 year?
So, in the last 1 year, we have gained market share in Bangalore. We estimate, because the residential real estate market, there are different agencies which put out different numbers. We expect that our market share is in the region of about 6 to 7% in the city of Bangalore, of the total sales.
Okay, thank you. Second question is on the Brigade Tech Garden in Bangalore. Since very long time we are talking about the hard options and but all in all still the leased area is at the same level. So what's the major issue that we are facing in the Bangalore Tech Garden?
So as far as the hard options are concerned, a portion of it is should be confirmed in about a week or two. We are in discussion with the tenant. This is because they are also expecting their employees to come back. They still want to go ahead with the hard option. They have the requirement because their hiring has been very robust. But at the same time, they have to phase the take-up based upon the reoccupancy trend. Okay. Apart from that, Brigade Tech Gardens, we have recently closed a market transaction, plus 2 transactions are in principle confirmed. Okay. So we are seeing the velocity. Again, I would like to reiterate that unless and until people come back to offices, no, this velocity will still be slightly low. But the interest is there. Like we are seeing site inspections happening, we are seeing the RFPs actually coming by. So it's just a wait for another say one quarter or so.
Okay. So last question on the residential real estate residential market. So in the presentation we have written the strong pipeline of the ongoing project of 18.11 million square foot. So it's will be a launch pipeline for next 3 years.
That's correct. That's correct.
That's okay. Thank you, sir.
Thank you. We'll move on to the next question. That is on the line of Pritesh Seth from Edelweiss Wealth. Please go ahead.
Yeah, sir. Thanks for the opportunity. So my question is on the residential side. So last quarter you highlighted about 7 million square feet of land deals across Bangalore, Chennai, and Hyderabad. So those are still under active discussion, and I mean, what's the status on that? That's my first question.
No, as I mentioned, in the earlier question, we have signed a term sheet for one of the properties in Chennai, which should give us about 1 million square feet of the saleable area, and it is under due diligence process. And once that is done, we will go through with the transaction. Rest of the things are still under various stages of negotiation.
Okay. And just on the leasing part, so 1 lakh square feet you have leased out in this quarter. What are the rentals that you are getting? Is still near to the market, or are there any pressure in the rentals?
So as far as this 1 lakh transaction is concerned, 50% of it has come from Ahmedabad market, that is BIFC. So there we have been able to push the rentals higher than our weighted average earlier. So we achieved a kind of around 5% premium over there. And apart from that, whatever transactions we have closed, it's in line with the market. I wouldn't say that the rentals, we are actually stressed in terms of the rentals. We have achieved greater rentals, higher rentals than the weighted average rentals for the respective properties.
Okay, fine. Thank you. That's it. Thank you, and all the best.
Thank you. The next question is from the line of Shivan Shah from Saral Management. Please go ahead.
Thank you for the opportunity, sir. So my first question is, what is the average occupancy rate at GIFT Ahmedabad for the office building?
See, BIFC as on date, so far as I remember, it would be around 28% as of the last quarter. But as we speak, we already have in principle confirmation for another 22%. So we should cross 50% in this quarter, and we are expecting around say 70% by the end of this financial year. So that's how it is progressing. BIFC has been robust.
That's great. And also, sir, one more question on the Bangalore front. What is the incremental revenue as a rent realization in terms of percentage? How much has the rent been increasing year on year?
So, see, as far as the overall rentals are concerned, this year we would from the existing, it would be somewhere around 400 crore, and whatever the additional will come from the new leases, that's particularly WTC Chennai, See, as we go ahead, even in Brigade Tech Gardens or Bangalore, whatever we close over the next 3 to 4 months, okay, another 3 or 4 months would be the rent-free period for the fit-outs. So the new lease rentals will actually be meager. It will all hit in the next financial year.
No, I'm asking in terms of rent realization. As in terms of rent realization, how much is the year-on-year increase in terms of?
Normally, if you are just asking for about the increased delta, so it would be somewhere around 4.77%. If we just because in many cases we have 5% per annum, in many cases we have 15% every 3 years, and we haven't seen a kind of withdrawal or renegotiation in the rentals. Okay, so it would be on an average 4.77.
Okay, thank you so much, sir.
From the existing leases.
Yeah, thank you so much. Got it clear.
Thank you. The next question is from the line of Karan Khanna from Ambit Capital. Please go ahead.
Yeah, thanks for the opportunity. So firstly, on your residential portfolio, you launched Cluster 3 of Xanadu in Chennai during the quarter. Can you briefly comment on the pricing here and how is the pricing behaving here? Because what we understand is that unlike Brigade Residences at WTC Chennai, projects at the Mogapai location, including Xanadu, are not seeing any significant price hikes. If you can comment on that.
So I didn't get the last part of your question. Are you asking on the pricing at Xanadu, Chennai?
That's right. Pricing and how is it behaving compared to Brigade Residences at WTC Chennai over the last quarter or so?
So clearly these two are very different micro markets, Mogapai and the old Mahabalipuram road where the IT sector is located. The Xanadu Chennai is performing extremely well, has performed very well in the last quarter, in the last few quarters. The average realization there is in the range of about 7,000, 7,200. The volumes have been quite good. We have done about 25-30 units a month in the last quarter. The residences, which is on the IT corridor, also has seen quite good traction in the last quarter, and the realizations there are in the range of about 10 to 10,500 as well.
Sure. And continuing on your residential portfolio, we've been hearing about shortage of construction material in Mysore. So any thoughts on the same and whether this can impact your ongoing and upcoming projects like Topaz and Sapphire?
No, currently there is no shortage of material. There is no issue. That's what you said, no? Shortage of material. Yeah. Currently there is no shortage of material, and the Topaz is almost complete. We are in the process of obtaining the completion certificate, and that should happen in this quarter for sure, is what we expect. And there is no issues at present on material availability or labor availability for that matter.
Sure. On your commercial portfolio, in the previous call you mentioned that Brigade Southfield has been completed with fit-outs underway and rentals expected from July. However, your FY22 presentation shows it's under construction with a balance capex of around 25 crores. So can you help us understand that aspect?
So it is the project is complete and the rentals will commence from 1st of July. So the documentation is complete, and whatever little bit of expenses to be incurred is based on when clients occupy some equipment, we need to install based on their timing, their requirement, and bit of coordination will be required. But as far as Brigade is concerned, it is leased and rents will commence from 1st of July.
Sure. And lastly, on your retail portfolio, can you help us understand the current consumption trends and at what level of consumption you expect the rentals to normalize? And also, as a follow-up, will it be fair to say that the built-in or contracted escalations over FY20 to 22 would be materialized once the rentals normalize? That's my last question. Thank you.
Okay, thank you. Good afternoon, Nirupa here. See, basically what we are seeing is that the FY22, the Q1 of FY22 is again significantly better than what we witnessed in Q1 of FY21. So for instance, if in FY we recovered only about 50% of the rentals from FY20, but in FY22 we're projecting a much significantly higher recovery. Currently we're projecting only 65%, but it could be much higher. In July has been extremely positive. So if I just look at the month of July, even though the footfalls was just about pre-COVID levels, the sales consumption in terms of what the malls did was almost 90% of what it was pre-COVID levels if I look at, if I compare like-to-like stores that were open. So we are seeing a fairly healthy recovery. Some amount of rental relief in obviously Q1 when there was the lockdown. Maybe about 75% of the stores will have some sort of rental relief in Q2, but by the 50% of the stores will have some sort of rental relief in Q3. We're looking to sort of stop all the rental reliefs because, or maybe just 10 to 15% of the stores might have it based on whatever negotiations we've had. But by and large, assuming there's no further shocks to the system, we should be on track to get back to the to 100% lease deed rentals from next fiscal year. But like I said, 85 to 90% will be back to lease deed arrangements by Q4 of FY22. Generally, we have quite a bit of stores that have come for churn or come for renewal. And I'm happy to say that on average, the rentals that we're able to negotiate with the tenants is on average, I would say 23% higher than what they were before. If it's just a renewal, on average, that amount has actually gone up to 30%. So suppose somebody was paying us 100 rupees, it's gone up to 130 rupees. So we've been able to get significantly higher rentals for whatever vacancies that there are or any churn that's there in the malls.
Sure. Thank you. Thanks.
Thank you. The next question is from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks for the opportunity. My first question is on the business development. So you mentioned that significant portion of the 500 crores QIP money will go into business development. Could you share what kind of GDV addition or top line addition you are looking at with this proceeds? So that's the first part. And the second part of that question is that can you take more leverage, considering that on the residential you have very low debt? Can you take more leverage on the resi side to add more projects, considering the market is pretty stressed for unorganized developers?
See, on a generalized basis, we can say based on the funds raised, we will be depending on whether a particular project is purchased, land is purchased, whether it is taken on joint development. It all depends on that. If it is purchased only, it may add say 5-6 million square feet. If it is not purchased, if it is only for joint development, it has the potential to add even 25 million square feet. So that way it will be a combination. But you rightly mentioned that we have the potential to increase our debt because the debt equity ratio has come down due to a combination of reasons, and which is increasing our overall equity by raising the QIP, and also by reducing our debt due to performance of the projects. So that way there is good opportunities there. Just the residential itself, it is a 0.3:1 debt equity ratio. And the overall debt equity is about 0.86:1. There again, our CFO has said several times that part of it includes the joint venture partners' debt. If you remove the joint venture partners' debt, we are sub 0.6:1 is the debt equity ratio. Yeah, I think Atul, CFO, will add a few more points.
Mohit, you are right that our debts are low in residential, but for buying land, we'll not prefer doing a debt, because land financing is one of the most expensive financing. So we'll be effectively using the QIP money to buy the land, and maybe the construction finance will do through that. So that is our strategy. But if there is a good land, we can look at that also. But right now we have enough QIP money, and we would use our residential debt only towards the construction financing of the new projects.
Sure. Any top line estimate that you have, let's say from 500 crores, if you are investing 350 crores, what is the top line that investment can generate in terms of rupees crores?
So see, as I mentioned earlier, if it is going to be purchased only, if the entire money is used for purchase, then in terms of revenue, it can add 3,000 to 4,000 crores, anywhere between 3,000 to 4,000 crores. And if it is entirely joint development, it can add 15,000 crores. But if you take a combination, but I suppose 9,000 to 10,000 crores is possible estimate.
Sure, sir. That's helpful. So my second question is on you alluded last time around that you have taken some price increases in your projects. Could you throw some light this quarter? We've seen the realization going up 5%. Could you explain how much of it is like-to-like price increase and how much would be due to mix change?
So we did take price increase little during the quarter. During the quarter, we were a little careful because lockdown was still operative. From 1st of July, we certainly have taken a price increase, but the increased realization has been a mix of changed product mix and in certain cases price increase.
And sir, how much of the realization increase has happened since July? In July?
So in terms of price increases across most, took about 2 to 3% price increase as the first step. So clearly there is a pressure on costs due to increase in costs of commodities like steel and other metals. So we did take a price increase. We do see that prices will firm up due to this cost pressure.
Sure. And sir, my last question, this is for Atul. We have about 1,000 crores of debt as capex debt in our out of our total 4,200 crores gross debt. So once WTC rentals start coming in fully over the next 1 to 2 quarters, how much of this 1,000 crores capex debt gets converted into LRD?
So right now, in that WTC debt right now is around 600 crores. So this will get converted into around, we have already converted actually around 1,200 crores, and it will actually LRD will go up to 1,600 crores in WTC.
Sorry, sir. Incrementally, how much LRDs?
You can say around 700 to 800.
Okay, 700 to 800. Okay. Thanks a lot, sir. All the best.
And you're asking for WTC, na?
Yeah, correct.
Yes, WTC.
Yeah.
Thank you.
The next question is from the line of Parvez Akhtar Qazi from Edelweiss Securities. Please go ahead.
Hi, good afternoon, gentlemen, and thanks for taking my question. So, couple of questions from my side. What would have been the revenue contribution from BTG this quarter? Rental contribution.
Sorry. Yeah. BTG it will 16 crores a month.
Sure. And what would have been the contribution from the launches that we did this quarter to our pre-sales in Q1?
Pre-sales contribution.
Pre-sales contribution from new launches.
This quarter.
Pre-sales contribution from what we qualify as about 38 to 40%. Because what we call as a new launch in our definition, I will qualify, is that any project that we have launched in the last 6 months, for us qualifies as a new launch. So from that segment, about 38 to 40% of our sales by value came from the new launches.
Sure. And lastly, we have mentioned strong launch pipeline. So how do we see, do we have plans for any near-term launches, or these launches are going to be there only around the festive season?
See, it is already indicated. We have launched about 1.9 million square feet already, and another 1.2 million square feet will be launched maybe this quarter. It's all we have the permissions. It is subject to RERA registration coming, etc. And more projects will be there to be launched in the Q3, Q4. Some are under approval stage, so we are waiting for those clearances to happen. Probably when the next quarter investors call come, there will be more clarity, on the launches that we can do in Q3 and Q4. So we have the projects, and it's primarily approval stage and RERA registrations. Everything is adding a certain amount of time.
Sure, sir. Thanks. That's it from my side, and all the best.
Thank you. The next question is on the line of Amit Agarwal from Nirmal Bang. Please go ahead.
Thanks a lot for this opportunity. Two quick questions. Firstly, I know I might be repeating the question, but I just want to understand what's the rental relief given to the retailers in the first quarter gone by, and how is it going to be brought down, as Nirupa was pointing out. Point number two, is it possible to get a breakup of collections separated into residential, retail, and office and hotels? Is it possible to get that for the first quarter FY22, the previous year, and the previous quarter? Thanks. These are two questions.
Yeah, just to answer the first question, see, what we did is, in order to save a lot of time, because we have more than 150 plus retailers to negotiate with. So what we did in order to save time, and also what worked for us using the similar rental relief as what we gave last year. So it varies slightly from category to category. Obviously, cinemas will have a different in vanilla stores, and different from anchor stores, different from food and beverage. But by and large, what we are trying to do is, the revenues are between 0 to 50%, then we're trying to charge 50% of the rental income as per the lease deed. If it's between 50 to 60%, then typically around 60% of the rentals of minimum guarantee. If the revenues bounce back to between 60 to 80%, then we try to charge 75% of the lease deed. And if it's greater than 80%, then it's 100% of whatever was there for the minimum guarantee. The good thing is that we're seeing at least 20% of the stores doing greater than 100% of what they were doing pre-COVID levels, which is fairly encouraging. Maybe only 20 to 25% of the stores are doing less than 50% of their business. But I would say maybe 30% of the stores, I would say. But by and large, most of them are between 50 to 75% of their pre-COVID business. I'm talking for the month of July, not during lockdown. But it is encouraging to see a significant percentage doing above 80%. So there we will get at least 100% of the rental income.
Sure, thanks. And the second question, is possible, on the collection breakup?
Yeah, Atul will answer that.
You want collections overall?
Yeah, the overall collection which you've mentioned in the cash flow, like 7172. What I wanted to do, a breakup in terms of residential, retail, office, and hotels. Is it possible to get that?
Yeah. So we had a collection of 557 crores in real estate. Commercial lease was 94 crores. Retail was 12 crores. Hospitality 31 crores. And PMS, which is our management company, it was 23 crores. So this total up to 717 crores.
And what was it last year, if I may ask?
Last year, overall collection was 2,711 crores.
Yeah, the breakup is possible. I'm just comparing it. How has it moved? That's the only thing.
So Q4, I can give it this way. Q4 was 1,118 crores overall. Q3 was 681 crores. and 6 months 2020 112 crores because the impact of lockdown was there.
Sure. Thanks a lot. That's all from my side.
Thank you. We'll move on to the next question. That is on the line of Pritesh Chheda from Lucky Investments. Please go ahead.
So I have three questions. One on the retail. What was our pre-COVID rental and square feet? And is there any addition there?
Yeah. So pre-COVID, so if I look at FY20, the rental was around 111 crores. And we have currently 3 malls. We launched a new one in October 2020, Orion Uptown Mall, which is about 2.65 lakh square feet. We have Orion Avenue, which was there pre-COVID also, 2.64 lakh square feet. And of course, our flagship mall, which is Orion Mall at Brigade Gateway, which is 8.34 lakhs.
About 1.2 million, roundabout.
Yes.
Okay.
Yes.
And my second question is, 1/3 of our capital employed is in hotels. Incrementally, do we have any capital allocation plan between hotel, rentals and residential?
No. Currently, we don't have any allocation towards hospitality.
And my last question is, out of 5 million square feet, how much is Chennai and Bangalore? And what is our market share there? And to what extent is these two markets organized, and what is the growth rate of those markets? Residential.
Yeah. So residential, Chennai, we would be a small player because we have 2 projects in the last 2 to 3 years is where we have been active in the Chennai market. So our market share would be very small. But the good news in Chennai is that we are growing very well. Our products have been accepted well, and we therefore look forward to do more projects. We've just started. We've done extremely well. Again, only 1 project, so market share would be very small. Bangalore, I did mention, we would be about 6 to 7% of the total market, going by one of the sources, because as I mentioned, there are multiple sources for market sizes. And if you look at who it is, if you go by somebody else, we will be probably in double digits. But if we go by one particular source, which most of us use over a period of time, I think we would be about 6 to 7%.
And how much, to what extent is Bangalore market organized amongst listed and larger unlisted players?
How much of Bangalore market is amongst the larger and the listed players? Is that your question?
Yeah, listed and the larger unlisted players.
Listed and larger unlisted. Today, we would expect that probably about 60-70% of the market will be the larger listed and unlisted players. That's what we would expect. Market has consolidated substantially in the last 3 years. The share has moved up probably from about 30-40% over 60-70% today.
And the size of Bangalore market?
Bangalore market in terms of unit sales is about 40 to 45,000 units a year.
At about 1,000 square feet?
Yeah, at about 1,200 square feet.
Okay. Thank you very much, sir.
Thank you. The next question is on the line of Shivan Shah from Parallel Investments. Please go ahead. Shivan, your line is unmuted. Please go ahead.
Yeah. Have we considered, putting our commercial assets, hotels and malls and commercial offices into a REIT and listing it or something, or selling it to one instead of lease discounting?
Not for the time being. I think we do get various unsolicited offers. Each of them would be evaluated from time to time. But if you ask me whether it will happen in this financial year, no. The answer is no. So we will be mindful of all the opportunities that come by. And once we have a critical mass ourselves, we may look at it at a future point of time. But certainly not in this financial year.
Okay, perfect. Thank you.
Thank you. The next question is on the line of Alpesh Thakkar from Antique Stock Broking. Please go ahead.
Good afternoon, and thank you for taking my question, sir. The first one is a kind of follow-up from previous participants. Like you mentioned that 150 crores of land parcel capex is planned for FY 22-23. So what is the kind of where we are and also where we are in active talks with the party. So what is the kind of mix there in terms of JDA, JVA versus outright land purchase?
No, this particular parcel, I said it is an outright purchase, and which can give about 1 million square feet of saleable area, and with maybe a revenue realizable of 800 to 1,000 crores.
Okay. Fair enough. And in terms of what would be our strategy between Bangalore and other markets like Chennai and Hyderabad for the QIP money that we have raised, and what kind of geography mix that we'll have?
Our CEO residential Joshi did mention earlier we had about 80% of the revenue from Bangalore market, and this year could be 60%. 60:40, Bangalore and non-Bangalore. So I think it may continue in the same fashion, 60:40, with a plus minus 5% variation maybe there.
Okay, thank you. And my last question on the what kind of launch run rate would we target over next couple of years, given the strong underlying demand in the residential businesses across board, and most of the people are or the management from different companies are saying that we have a strong demand there. So what kind of launch run rate can we see going ahead for our company? That's it from my side.
Yeah. So see, we will certainly plan to launch somewhere in the range of 7-8 million square feet per year. We have a land bank to give 35 million square feet saleable area, which are all with proper lands, with where it can come to the market in the next few years, based on our own requirement, demand requirement, etc.
Okay. Thanks a lot for the clarification. All the best.
Thank you. Ladies and gentlemen, we'll be taking the last question. That is from the line of Venkat Samala from Tata AMC. Please go ahead.
Hi, sir. Thanks a lot for the opportunity. Sir, given the opportunity that we are seeing and the way that we are foraying now into the non-Bangalore market, and obviously the consolidation piece and the strong undercurrents which are supporting housing market, and obviously we do have the QIP money war chest that we can use to sort of catalyze our growth. So do we have any vision in terms of where we want to be in terms of pre-sales in the next 3 years?
See, I would put it this way. It all depends on opportunities and the general economy. But generally, when this question is asked earlier, I have said we would aim to have a growth rate anywhere between 20 to 25% and maybe 30% growth year on year is what we aim. I think that is the intention.
Okay. Fair enough. So does that hold for this year as well? I mean, how do we look at this year, assuming that there are no more third waves, etc.?
See, the intention is definitely there, and our team is working towards that. And as you rightly said, if there is no third wave, we expect a much better growth rate, much better figures than last year. And yes, as the MD, I'll be pushing the team for 20 to 25% growth. And so we are. Let's see. God willing, it should happen.
Right. Sure, sir. Thanks for that. With respect to commercial, if you could just give some color as to what would be the client profile in terms of, what would be the contribution from MNCs and how much would be the contribution from IT, ITES, and financials to of our current leasing, that is.
Our Subrata earlier mentioned 80% is the IT, ITES, and the remaining 20% is non-IT, ITES. So very substantially it will be from MNCs, because some of the large Indian companies they've all got their own campuses and their own buildings. So that way from the big guys within the country, less business, but from MNCs it will be the bulk of the business.
Right. And this also pertains to the current leasing portfolio that we have, right?
Yeah, I think more or less.
Okay. Sure, sir. And assuming that we don't have any more third wave, etc., based on the discussions that you are having with the tenants, when do you expect the leasing uptick? I mean, which quarter can we expect?
I think third quarter FY22, that is October to December quarter, we can expect leasing uptick, provided the international travel and everything resumes. But see, if you, from whatever we have read in the media or watched companies, people speaking on TV, the hiring process is quite robust, and considering we have 190 billion or nearly 200 billion software business in the country, and the NASSCOM has announced it will be a double-digit growth, so which is not a small amount at all. A $20 billion addition, or if not more, in the coming year is a significant jump in business for the office leasing and residential business too. They go hand in hand. So sometimes the office leasing leads the business, sometimes the residential, but they go hand in hand. It is more like, we expect overall in the next 12 months or so, 200,000 more jobs will be created in the IT sector.
Right. Okay, sir. And one last question. In response to previous participants' question, you did mention in terms of how recovery happens across different slabs, what percentage of minimum guarantee we can expect for the retail malls, that is. So my question is, assuming that we do reach 100% of the pre-COVID levels across the board, so how do we look at the contractual escalation? I mean, assuming that we know maybe towards Q4 of FY22 or starting FY23, whenever the normalcy does set in, so the contractual escalation, would that happen over FY20 level? Is that the right way to look at it?
No, see, contractual escalation. No, just to clarify, contractual escalations will happen as and when they are due. There is no change in contractual escalations as such. And as far as the full rentals are concerned, based on whatever concessions we have given or not given, once 80% of the business recovery is there, we get 100% of the rent.
Okay. Fair enough. Okay, sir. Thank you. Thanks a lot. That's it from my side. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Prem Khurana from Anand Rathi. Please go ahead.
Hello. Yeah, am I audible? Hello.
Yeah, audible. Yeah.
Hi, sir. Thanks for taking my question. Sir, first question was on the unsold ready inventory that we have. So when I look at the numbers now, I mean, till some time ago, a few years back, I mean, the number used to be seriously negligible for us. I mean, less than 1% of the total unsold inventory. But over the last few years, it seems as if the number has gone up substantially. So if you could help us understand the thought process, is it that we are holding on to some of the inventory to kind of make good for the inflationary pressure, or just that because now we've become big, we are launching larger phases, which is when you get to have some inventory kind of stay with you for some time? The number used to be less than 100 crore rupees, and now it's almost around 700 odd crore rupees in terms of unsold ready inventory.
So this is Rajendra Joshi. So the unsold ready inventory, if you actually look at it in the last couple of years, we have actually worked towards reducing the unsold ready inventory. As an organization, we do not keep an inventory to be sold later for a higher realization. In fact, as an organization, we always believe faster the sale, better for the project and the organization. So what also has happened in the last couple of years is that we have finished quite a few projects, and therefore the ready inventory has come into the kitty, though we have worked on exhausting what was available earlier. So which is why you will see a little higher number in the current quarter, but we will work towards reducing the same.
Sure. And Rajan sir, just to continue on residential real estate, I think last quarter launch pipeline reflected residences at WTC A3 block to be launched in the near future. Seems that it has been removed from the launch pipeline. So any change in thoughts there?
So the A3 tower in WTC Residences was planned to be a serviced apartments. There was a change in thought. We are still wondering, given this uncertainty in the hospitality sector, we are still working on that option, which is why we have removed it from the launch pipeline.
Sure. And on, sir, Atul sir, just one question on the numbers. I think when if you could please help me reconcile. So when I look at our cash flow numbers, the interest outgo is around 88 odd crore rupees, and when I look at the P&L income statement, the number is in excess of 110. So if you could please help me reconcile this difference, the gap.
Yeah. So I got it. So this time what has happened, Prem, is that we have capitalized PREPL, that are WTC property which has been capitalized in March 31st. So its full interest is coming in the P&L, which is around 23 crores. So that is a difference which you will see both in the cash flow and in the difference in increase in interest in P&L.
No, sir, I understand the increase part. I was wondering, why is it that our actual outlay is lower than the income statement number?
Yeah. So what happens is that there is also a interest on debentures on GIC, which is coming into the financial numbers, but it is not coming into cash flow because that is paid as and when money is available from LRD or from some excess money which the company generates out of its operations.
Sure, sir. Sure. Thank you. That's it from mine. Thank you for taking my questions.
Now, only at that A3 in World Trade Center, say launch has not happened, but the construction is progressing.
Sure. Okay. The design is still the same, sir. I think we were planning to have one room kind of setup, so it still is the same.
So it is the same for serviced apartments. It is there, but it is designed in such a way that it can be combined. 2-bedroom units can be made.
Okay. Sure. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Ms. Kavita Shankar, Executive Director of the company, for her closing comments.
Good afternoon, everyone. In closing, we thought we would like to mention some recent highlights. We are really proud to be recognized among India's top 100 best companies to work for by the prestigious Great Place to Work Institute and Economic Times for 11 years in a row. We're also the only real estate developer to be featured in the list this year. Furthermore, we've consistently been awarded the best in the industry, large workplace study conducted in India. The Great Place to Work Institute also awarded our subsidiary, Brigade Hospitality Services Limited, with the first place in India's Great Mid-Size Workplaces 2021, and fourth in the small and medium workplaces in Asia, despite this being a crisis year for the hotel industry. We've remained sensitive to the impact of the pandemic on our employees' lives. Our HR and admin team work tirelessly to support not only our team, but the team's families as well. We have an in-house medical emergency team to follow up and conduct virtual check-ins with affected employees and family members. We've set up an employee emergency fund, a self-help platform on our intranet, and professional mental health support, and much, much more. Continuing our fight against COVID, Brigade organized vaccination drives for our employees and their families, our associates and partners. We've helped vaccinate around 20,000 people so far. We also have an ongoing vaccination facility at our Orion malls where anyone can walk in and get vaccinated on all weekends. COVID relief and outreach measures by the Brigade Foundation continues to support communities in need. Our real estate accelerator program, Brigade REAP, will be celebrating 5 years since inception and is excited about launching its first successful exit at 5x the investment. Some of the highlights from the team include a partnership with Start AD to deliver value to Aldar Properties, one of the largest developers in the Middle East. We also had a maiden PropTech summit called One World, One Realty that was held in April with over 2,000 participants from 8 countries. Brigade REAP also launched India's first PropTech-focused syndicate fund, PropTech at REAP, which went live on the Let's Venture platform. The Indian Music Experience, founded and supported by the Brigade Group, is gradually opening its doors to visitors as per government norms in the current situation. This unique interactive music museum won 2 awards over the last quarter, the Best NGO in Art and Culture from the Global NGO Expo, and we also got recognition from Europeana, an organization in the EU, for IME's digital storytelling of Amrita Varshini. Apart from the many sustainability efforts in our projects, we set out to restore green cover in our city, to plant 30,000 trees to commemorate our 30th anniversary 4 years ago. We are very delighted to report that we have now reached a significant milestone of 50,000 trees across our various project sites in multiple cities. As Brigade strongly believes in being socially responsible and giving back to the communities in which we operate, we will continue in our efforts to make our cities beautifully green once again. On that note, we'd like to thank you all for taking the time to hear from us today. All of us at Brigade wish you well. Stay and stay safe. Thank you.
Thank you. Ladies and gentlemen, on behalf of Brigade Enterprises Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your line.